Hey guys, let's talk about something controversial today. An interesting question. Can you time the market? I'm gonna play a clip by a famous investor, Peter Lynch, and I'll let him explain his thoughts on market timing.
More people lost money waiting for corrections and anticipating corrections than the actual corrections. Well, you ought to look in the mirror every day and say, what am I going to do if the market goes down 10%? What do you do if it goes down 20? Am I going to sell? Am I going to get out? If that's your answer, you should be reducing it today.
So as we saw, Peter Lynch said, more money has been lost waiting for corrections than in the actual corrections themselves. It's not timing the market that's important, but time in the market. Let's talk about it. So let's talk about terrible timing Tiffany, a bottom buying Brittany, and slow and steady Sarah. So we'll talk about these three people and to see what the difference is between trying to time the market, if you do it perfectly, or if you just invest over the long term. All three of these ladies, they have an extra $200 every month to invest into the stock market. And all three of them are going to be able to invest that same exact amount throughout a 40-year period. So terrible timing Tiffany, I can't even say that fast. Terrible timing Tiffany saves her $200 every month until the very, very peak of the market. And on the worst possible day, right before the crash, that's when she invests the amount she had saved up. And then that amount she'll keep in the market. And she keeps saving up until the next top of the market. And right before the market breaks again, she'll invest at the worst possible time. After 40 years of investing in a very, very bad way, Tiffany has $663,000 in her investment account, even though she only contributed $96,000 total. So even though she put in less than $100,000 and her timing was terrible, she still did pretty good. She multiplied her money by 6. So next we have bottom buying Brittany. She has this amazing gift of knowing exactly when the market's gonna bottom. So she saves up her $200 every month, and when the market bottoms, she takes the amount she has saved and she dumps it into the stock market, and then that amount will stay in the market. And she saves up her $200 a month again until the next market bottom, and she'll buy in more. So guess what her return is after 40 years of perfectly timing each and every bottom? Brittany's total comes in a tiny little bit less than $1 million of $953,000. So her $96,000 that she has saved up over that time has grown to almost $1 million. Now let's find out what happened with the boring, slow, and steady Sarah. All she does is every single month, she takes that $200 and she puts it into an index fund. She doesn't figure out about market timing. She doesn't read market news. She doesn't understand all this fancy financial jargon, all the futures and derivatives and Forex trading. All she does is every single month, she puts in her $200 into that account. And guess what happens? Her account grows to $1,386,000. So even though she put in the least amount of work, her consistency is what wins out. So instead of trying to time the market, instead of waiting and putting off till later to invest, learn to invest every single month. Consistently put money into the stock market. That is a guaranteed way to grow your wealth. So I wanted to talk a little bit about what's going on in the world right now. There's always going to be an economic worry on the horizon. The term is a wall of worry. I'll put in a little clip a little bit later just to kind of explain what that is. But ever since the market has began over 100 years ago, as the bull market will continue to go up, there's always scary headlines.
Okay, now we'll get to the important stuff. There's always something to worry about. This is the difference. This is what happens in the stock market. Because see, everybody's got the brain power to do well in the stock market. The question is whether you have the stomach for it. That's the key organ in the body. There's always something to worry about. I went to school, grew up with a kid in the 50s. So people weren't buying stocks in the 50s because they thought that another Great Depression was going to happen. In addition, people were very scared about nuclear warheads and nuclear war in the 50s. The 50s was the best decade of the century for the stock market, except for the 80s. Only slightly better. The 80s were only slightly better. People didn't expect a lot. We had an okay, it wasn't a great decade. They just didn't expect much. We made it through. And stock market was terrific. People were building fallout shelters, stock market canned goods. There's something about going to Vermont, building a fallout shelter, putting canned goods in it, that you don't buy Minnesota mining or you don't buy Eastern Dakota. I mean, the syllogism just doesn't work out that you're buying lots of water, buying a shotgun, buying frozen food that will stay in the freezer with your own generator, and you're looking at growth stocks. Doesn't seem to work out that way, you know. And I remember in the 50s, I mean, I remember literally in classes, I was in elementary school in the 50s, and they'd come in, they'd have one of these air raid drills. Somebody in a yellow hat would come in, they'd blow a whistle, and you'd get under your desk. Even then I says, I don't think this is going to do a lot of good, you know. But people were worried about a depression and nuclear war in the 50s.
And as we get frightened out of the stock market, that's when we do the worst. So it's better to try to limit your exposure to the negative news. Maybe unplug a little bit from that. Learn to just enjoy, go outside a little bit more, enjoy the fresh air, enjoy each other's company, find out where you can actually connect and hang out with people. Go take a walk, go take a hike, but learn to listen a little bit less to some of our toxic news. They make money on these crazy headlines that will suck you in. And the more of these headlines that we read, the scarier the world will appear. We're looking at some uncertainty right now. We don't know what's going to happen with the new budget cuts, the new variant coming out of South Africa, the chip shortage, all other kind of things that we may not be aware of. But it doesn't matter. If you invest consistently and ignore all this negativity around you, you'll do just fine. In fact, not only will you do fine, you'll beat out the majority of professional money managers. And as always, I wanted to show you guys my Roth IRA. And usually people will say, practice what you preach. But I did want to say a little bit of a confession. My Roth IRA has jumped up recently in the last couple weeks. I knew there was a little bit of an extra uncertainty in the market. There was some other things going on under the surface. And the market was looking very wobbly short term. So I bought some insurance policy against the market. I got some options for the downside of the market. And as the market slipped lower, I made a little bit extra money on the way down. But now I'm going right back into the market. And if it drops lower, well, then I'll just kind of ride it down with you guys and ride it right back up whenever the upward momentum will begin again. Looking at the market over the last couple years, it has been insane returns. So we can't really expect that it's going to continue to go quite that fast in the future. We'll probably hit some bumps along the way. The market might go flat for a little bit, and that's okay. The best way to invest, just do it consistently. So thank you for watching this video. If you found it helpful in any way, hit that thumbs up button. I would appreciate that tons and tons. We're about to hit 2022, so it's going to be new and exciting things up ahead for us. So I wish you all well. Love you guys. Thank you for joining me. Artie, out.